One of the biggest obstacles in any divorce is determining how the IRAs and 401ks are going to be split up. There are critical decisions you need to make, there are processes you need to follow, and there are common mistakes you need to avoid. In today's video, we're going to tackle all of those issues and questions, and I'm going to give you the strategies on how to properly make sure that your IRAs and 401ks are fairly distributed so that you're not taken advantage of or you're not giving away more than you need to. All right, so I want to go over 3 different things you need to consider as you're moving your IRA or 401k in a divorce. First, let's go over the options you have. Second, I want to talk about how you do it. Now, it's different for IRAs and 401ks, so you need to know the rules. And then third, I want to talk about common mistakes that you should avoid. I see a lot of mistakes as a lawyer and someone that runs a retirement account company that people are making every day here when they're moving over a retirement account from a former partner or as they're distributing out assets from their IRAs or 401ks following a divorce. So let's hit the options here. Now, generally speaking, you should operate from the default that we need to split our IRAs and 401ks equally. Now, you might be in a marriage where it's like, all right, I've got $200,000 in my 401k at work. My spouse has $200,000 in their 401k at work. We're each going to take our own 401ks and we'll split up the other assets. One of the things about IRAs and 401ks is they're held in an individual name. You don't jointly title a retirement account. Like your home, you might own in both of your names. You might have a bank account in both of your names or a brokerage account that's a joint account. But our IRAs and 401ks are individually held, so they need to be split up during the divorce proceedings. Now, just because they're individually held doesn't mean you have individual rights to it. In general, you should expect to be dividing your assets entirely 50-50. Now, you might have a prenuptial agreement or a postnuptial agreement, and if that's valid, you're going to follow what that agreement says. But all else being equal, and make sure you're getting your own advice in your specific state, operate from the assumption that you need to divide those IRAs and 401ks equally. Now, as you look at your total assets, you could say, all right, well, you take the home and the $200,000 of equity there. I'll take the 401k and the $200,000 in that 401k account. So you can kind of mix and match assets and say, well, you take that asset and I'll keep the IRA or 401k. And that's okay. I'm going to get into some of the mistakes that people often make there, but you can separate out other assets and get credit for certain assets that one's taking over the other. But all else being equal, one of the safest ways to make sure you're protected is to just equally divide up the IRAs and 401ks. Now, the first thing you need to do is look at what IRAs and 401ks do you have versus what does your spouse have. If there's a lot of imbalance between there, maybe there's a non-working spouse, maybe someone who takes care of the kids more or has other responsibilities in the family or household, you might have an imbalance there, and the working spouse or the higher income earning spouse might have to offset and give their account or a portion of it over to the non-working spouse. Now, there's no way I can go over all the comprehensive issues here. There's so many different assets you might have, so many issues in your divorce, and so many reasons why one might be entitled to more or less. But as a general rule of thumb, look at splitting them up. And as we do, I'm going to get to the process on how you do it, which is different for a 401k than it is for an IRA. And also, you need to make sure you understand the differences between a Roth account, an after-tax account, a pre-tax account, and a traditional account. These all have different values to you in the end in what you receive as part of the divorce. So I'm going to break down those here in just a moment. Now, as we get into the how-to, it's important you understand that we have 401ks, which would also include 403bs and employer-based retirement accounts. And we have IRAs, which includes individual IRAs such as traditional IRAs, Roth IRAs, and SEP IRAs. These are totally different account types, and they pass and they transfer to the other spouse under different rules. So let's go to 401ks and any employer-sponsored plans. When you are dividing these up in a divorce, you must have what's called a QDRO. That stands for a Qualified Domestic Relations Order. This is a separate order after the divorce is done. You have to go get this stupid separate order called a QDRO. This is required under federal law, so every retirement account administrator is going to require it when you're dividing up a 401k. This includes solo 401ks, again, 403bs, and other employer-based retirement accounts. Now, this QDRO is really just a separate little order that says, hey, this 401k account is being split up in this way. This is the 401k account of Jane, and Jane is dividing half of it to go to John. And so if it's a $200,000 account, $100,000 is going to go to John's IRA. Now, it's important to understand here, whether we're talking about IRAs or 401ks, there is no tax or penalty when you're moving moving that account. So if you're splitting up your 401k in half and your spouse is getting half of it, there's no distribution, there's no tax, there's no penalty. Okay, it's totally tax neutral. That account, that amount of 401k dollars or IRA dollars moved now just becomes the IRA or 401k dollars of the other spouse. No tax or penalty. It goes into an account in their name. Now again, back in the 401k world, that order is done by a QDRO, qualified domestic relations order. Now, if you're on the other end of this, and let's say you're getting half of your spouse's 401k, you're gonna go open up an IRA. Now, for example, let's say that you're going from your 401k of your ex-spouse to your IRA. And let's say this was a traditional 401k. Well, we're gonna do a traditional IRA. Now, when 401k speaks, sometimes it's called pre-tax. Basically, what that means is you get a tax deduction for putting the money in, but it's gonna go from the traditional 401k to a traditional IRA. Now, let's say on the other hand, that is a 401k Roth account. And sometimes that is called post-tax, maybe after tax. That term can get confusing here a little bit, but this is Roth dollars, meaning you didn't get a tax deduction, but as this money's growing, it's gonna come out totally tax-free at retirement. Whereas a traditional account, when you start pulling the money out at 59.5 or later, you pay taxes, you pull the money out. As you pull money out of a Roth, there's no tax on the way out, so it's a little bit better account. But if you're moving money from a Roth 401k, that needs to go to a Roth IRA. So if I'm the other person receiving this from my ex-spouse, I'm gonna be opening up a Roth IRA account. There's gonna be a direct rollover request of the other spouse here that had the Roth 401k account, directing them that says, hey, based on this court order, and I've got this QDRO, you need to move that $100,000, for example, into a Roth IRA in my name. Now, when they do that, no tax, no penalty to either spouse. Now let's move over to IRAs here. Those operate a little bit differently. Now, the nice thing about IRAs and moving those, it's easier. You do not need to get that stupid QDRO. You don't need a separate order. If your divorce decree says, hey, this party had an IRA, this other's ex-spouse is gonna get half of it or this amount of dollars from it, that just needs to be stated in the divorce decree and in the court's final order. You don't need a separate qualified domestic relations order to move an IRA. So we're typically just gonna look at the divorce decree itself. Now, this might be specified in the property settlement or some settle agreement that's associated with the divorce decree, but as long as there's a specific identification of that IRA account, an indication of how it's being split up between the two parties in the marriage, that is all you need to move that IRA from the divorce. Now let's go back to similarly how we talked earlier on the 401k. Let's say that this IRA is a traditional IRA. That is going to get moved to a new traditional IRA in the ex-spouse's name. So if I'm the one receiving the IRA, I've got to go open up my new IRA account wherever I want. This could be at the broker-dealer I want, a financial advisor. This could be a self-directed IRA, depending on what you want to invest into. But this is a traditional IRA. That's the account type you need to set up. And again, all you're going to need to show is there would be a transfer request that's submitted to the person in the divorce that has the IRA that's being split up with a copy of the order that says, hey, send this amount of money to my ex-spouse's IRA account. No tax, no penalty, the money moves. Now that IRA is in an account in the other spouse's name, and those IRAs have now been split. Now, if you had a SEP IRA, it's going to operate the same. A SEP IRA is traditional dollars. It is pre-tax dollars. You got a deduction to put it in. It grows and you don't pay tax, but you do pay tax as you pull the money out. So if I'm on the other end of this and we're splitting up this SEP IRA of my spouse, ex-spouse, I am going to set up a traditional IRA. I don't set up a SEP IRA. That's meant for a self-employed person. You may not be one, you may be one. It doesn't really matter. The easiest thing, just set up a traditional IRA, and those SEP IRA dollars will move over, again, according to what is specified in the divorce decree. But no separate QDRO required for the SEP IRA either. Now, the last one here I want to talk about, and this is where mistakes start getting to be made, and I'm going to dive into this more in a little separate section here on the mistakes you've got to avoid in separating out IRAs and 401ks. The next is a Roth IRA. Let's say we are splitting up a Roth IRA, and let's say it's your Roth IRA that needs to be split up. Again, this will be specified in the divorce decree. It'll identify the account, where it's held, that it is a Roth IRA, and it'll specify how much or what percentage is going to go to your ex-spouse. So they would set up their own Roth IRA account. They would again submit the transfer request to the Roth IRA of the ex-spouse, and then the money moves. Again, no tax, no penalty. Now we have two Roth IRA accounts. Now, sometimes you may want to sell to cash. Sometimes you might have an S&P 500 fund, or maybe you've got Apple stock. This could be a self-directed asset, but you may need to split up the asset or the stock, or you may need to split up the cash in the account as well. And so sometimes it does get a little tricky on what assets the account owns, but as a general rule of thumb, you want to specify in the divorce decree the percentage of the account or an exact dollar amount that you agree upon. But remember, whatever you do, that's what you're stuck with. So if the market is high or your investment has a high value right now and that goes down and you said 50%, well, they share in that 50% until the account moves. On the other hand, if you said, well, it's 100K and the account's worth 200K, but by the time they get around to doing this transfer, the account is only worth 180K, well, they still get 100K. So you want to be careful in the divorce decree or in your agreement itself on how you're splitting up the account itself. From my experience, the easiest way to stop any confusion is just to specify an exact dollar amount, and then the parties need to act quickly following the divorce to split this up. The more time that passes on this, the more confusion, the more disputes, and the more you have to have your ex-spouse involved in your life. And that is mistake number one to avoid. Make sure you are very clear in your divorce decree or in your settlement agreement, qualified domestic relations order, wherever you're documenting this based on your situation, how you are splitting up that account. Is it a dollar amount or is it a percentage? There's pros and cons to that. Again, my recommendation is just do dollar amount and then move forward and get it done. But whatever you decided on, remember, you're stuck with it. All right, mistake number two, and I see this one all the time. I don't want you to be on the other end of this and losing out. Let's say there's a traditional IRA worth 150K and a Roth IRA worth 140K. Sometimes couples will be like, all right, well, you take the traditional IRA, I'll take the Roth IRA, and we'll cover that other $10,000 difference somewhere else in the agreement. Maybe you get the car or some household items or some money in a savings account, whatever it might be. That's a mistake if you're the one that took the 150K traditional IRA. Let me make sure you understand that. That $150,000 traditional IRA is worth less than the $140,000 Roth IRA. You have to understand this point. Roth IRAs, an account balance of 100K, let's say, is more valuable than a traditional IRA with an account value of $80,000. The reason why is the taxes. You've got to understand how a Roth IRA and traditional IRA work, and if you don't, you're going to get screwed up in negotiating your IRAs and 401ks in divorce. So let's take an example, very specific, and I'll be clear on this. Let's say we have a $1 million traditional IRA, and we have a $700,000 Roth IRA. This could be traditional 401k, Roth 401k, doesn't matter. Now, a lot of people are like, well, we got to balance this out. If you get the $1 million traditional IRA and I get the $700,000 Roth IRA, you owe me $300K. No, you don't really. Honestly, all being equal, I'd take that $700,000 Roth IRA over the $1 million traditional IRA. Here's why. When you start pulling money out of this traditional IRA, let's say you're 60 years old now and you're like, all right, I'm going to pull that $1 million out. Guess what? It's not $1 million. You got to pay federal tax. Let's say you're in a 30% tax bracket there. There's $300K. You've got to pay state tax. Let's say you're in a state that has a 5% state tax bracket. Maybe you're in California and it's 14. This could get worse. But let's just say you're 5%. That's $50K off the table. Oh, so now I've got $350K off the table. I really only have $650,000. So the value of a traditional account is discounted because there's taxes that are going to come out later as you pull the account out. Now, the easiest way to just make sure this is fair and equitable is just divide the Roth accounts 50-50, divide the traditional accounts 50-50. Do not get on the other end of someone saying, all right, well, I'll take the Roth IRA for $150 and you take the traditional IRA for $150 and that's fair and equal, right? No, it's not. You get screwed if you're in that situation. So make sure you understand the tax differences here. Your tax bracket may come into effect here, the state you're in, whether you have a state tax on it. So there's a little bit of variability to this depending on your situation, but as a general rule of thumb, realize the Roth accounts are more valuable than the traditional accounts. And mistake number 3, you have got to avoid. Do not distribute the account early. A lot of people make the mistake and are like, well, I got the IRA or the 401k out of the divorce. And let's say you're 45. You're not at 59 and a half yet where you can pull money out of an IRA or 401k with no penalty or tax. So you pull the money out early because you think there's some exception for IRAs and 401ks. There's not. There's no exception to this where you can take an immediate distribution. If you take the distribution early, you pay a 10% early withdrawal penalty and you take it into tax. Let's again say you're in a 30% federal, 5% state. If you got a $100,000 401k from your spouse, okay, 10% penalty, taking off 10K, 30% tax, taking off 30K, 5% state tax. Like, you actually got $55,000. You didn't get 100. So make sure when you're receiving the IRAs and 401ks, you're thinking about them for your own future retirement. We're not thinking about them for immediate assets and income. You need to worry about those from other sources, whether this is your own job, your own business, your own investments, or other assets that are coming from the divorce. Now, the other variety of this same issue where you take a distribution early is for those of you that are splitting up your IRA or 401k to your spouse. It's your account getting cut in half or a portion going away, and you decide, I'm just going to distribute it out. I got a 60-day rollover window. I'm just going to redeposit it somewhere in 60 days, and I'll just give my spouse the cash. Well, guess what? When you do that, you might have a 60-day rollover, but all that money you pulled out, that extra cash, it's not transferring under a QDRO, and it's not transferring pursuant to a transfer to divorce, so it's going to fall outside of the rule, and it's going to be a taxable distribution. So do not do a 60-day rollover because it's an easier way to get the money. You don't want to fill out all the paperwork with the divorce with the IRA or 401k administrator. You've got to follow the process. Don't try and do an end run around this by doing a 60-day rollover. All right, let's go through the options here. The first thing you needed to do is fairly negotiate and decide who's getting what IRA accounts and that you're clear on that in the divorce decree. The second thing, you made sure you got the order specified properly, whether this is in a divorce decree for your IRAs or you did a separate qualified domestic relations order, a QDRO, for your 401k, 403b, or solo 401k. And then the third thing you need to make sure you avoid is mistakes. Be careful on the Roth versus traditional and getting one versus the other. Be careful on taking an early distribution, and be careful on what you specify in the agreement in your divorce. Is it a fixed dollar amount or is it a percentage of the account? Realize there are consequences to going either way on that. Divorce is painful and stressful enough, so I want to help you avoid these mistakes so that you can have certainty and continue to grow and build wealth in your IRA or 401k. Make sure you're subscribed to the channel. We're all about strategies on how to save taxes, build wealth, protect your assets. I'm Matt Sorensen. We'll see you next time.